In this session, you will learn about different types of margins. Essentially, there are three types of margins: initial margin, maintenance margin, and variations margin. Let's look at each of them. Initial margin is the capital sum which an investor needs to park with his broker. This acts as a down payment in the investor's account to initiate trades. The initial margin is in the nature of collateral. An investor can offer cash and securities as collateral. Other collateral options include open-ended mutual funds. In most cases, especially for equity securities, the initial margin requirement is 30% or exchange-defined margin, whichever is higher. However, this may vary. And yes, both buyers and sellers must put up a payment to enter into a trade. After purchasing the stocks, a minimum balance called a maintenance margin needs to be parked with the broker. In case the margin drops below the limit, your broker will make a margin call. Post the margin call, the broker can liquidate the position if you do not make up for the required amount. Maintenance margin varies between 20 to 30%. However, it is subject to a minimum exchange charge margin and may change depending on the position an investor wants to hold in a stock market. Variation margin is the additional amount of cash required to be deposited in your initial margin account to bring it up to the initial margin after you have incurred sufficient losses to bring it below the margin maintained. Variance margin is thus the difference between the initial margin and the margin balance. Why are margins essential? Margins act as a cushion against the risk arising out of price volatility. Since you are now aware of the various types of margins, you can call the brokers at Motilal Oswal to get started with trading in the stock market. Investment in securities market are subject to market risk. Read all related documents carefully before investing.